I'm Professor Engelhardt. We're picking up here again with our series on the principles of macroeconomics. In this video, we're going to talk about exchange rates and international capital flows. So we want to deal with these three questions. That is, how do exchange rates work? Like, what are the elements that play into them in terms of supply and demand? What kind of effects do they have on different people? We also want to look at the connection they have to macroeconomic policy. So what connection is there between these? And then finally, we'll look at what options there are for how to manage exchange rates. So basic overview, we're going to cover the basics, get the supply and demand, the effects in different groups down, then we'll talk about the macroeconomic effects, and then finally we'll look at exchange rate policy options and consider what do we have to give up in each possible option. So let's look at foreign exchange markets. So what a foreign exchange market is, right? It's a market where we exchange one currency for another currency, right? So this kind of thing happens quite a bit because there's lots of trade that crosses borders and crosses currency zones, right? So, for example, if you're a tourist and you're traveling out of your home country to a foreign country that uses a different currency, you're going to be engaged in foreign exchange. Right? You're going to be exchanging your currency for whatever the foreign currency is on the way there, and then probably going the other direction on the way back. Similarly, businesses that operate in foreign countries, right, they're going to be buying or they're going to be selling. This means then that they're going to be interacting in more than one currency. So they're going to be exchanging between currencies as they are, say, gathering revenue in one currency but paying costs in another, or vice versa. Or investors. Investors will often invest in multiple countries so that you can get good diversification geographically. This then means that you're going to be dealing both with your home currency, where you're eventually going to cash in your wealth and spend it, and then also the foreign currency wherever you are investing. Now, there are alternatives to having multiple currencies. Right, so one thing is what we call dollarization or currency substitution. Right, so this would be a case where you adopt another country's currency as your own. Right, so there are a couple forms of this. One would be a complete form of dollarization. El Salvador has done this with US dollar. That is, they have said, we're not going to have our own El Salvadorian currency. We are instead just going to use the US dollar. Right? Or you could do it partially, right? So you have the case of Panama. The country of Panama uses both the US dollar and then also its own local currency as well. Now, sometimes you'll also see countries that adopt multiple foreign currencies and then just have those be used. We saw this after Zimbabwe went through its hyperinflation. They adopted a combination of, you could use the US dollar, you could use the euro, you could use the South African rand. So all of these were used as currencies within that economy. Now, another option would be to have a currency union, as we see within the Eurozone. So a bunch of countries coming together, forming a separate currency that really isn't governed by any one of them. Instead, it is an organization over all of them, the European Central Bank, that ties them all together in terms of the money that they use. And so we have options. So what do demand and supply look like in foreign exchange markets? It really comes from really three sources. That would be firms that are involved in trade, tourists, and international investors. Now, between these, I suspect international investors and firms involved in trade would be the most important for most economies, with the exception of small economies where tourism is an enormous part of what they do. But all of these are going to have a demand for and supply of multiple currencies that are going to be trading against each other. Now, with the international investors, it can sometimes be useful to break it down between owners and non-owners. Right? So owners would be those that are investing in some form of equity. So one form that they can take is foreign direct investment. So for example, if the United States, we have a company that wants to build a plant in India, let's say. Right? Well, in that case, we have our country has a particular company that is investing in a foreign country. So we call that's foreign direct investment. So for us to be outgoing, that is, it's going out of the United States into another country. For India, in this case, it would be incoming foreign direct investment. You can also have ownership just through portfolio investment through stocks. Right? So buying and selling stocks would be a common way that we can invest across borders, and this would be also somebody that's going to have demand and supply for foreign exchange. Also, you have the non-owners, that would be lenders. So this would include both bondholders and also banks that are lending across borders or through different currency zones. So why? So why do we engage, right, in this type of foreign exchange? Well, there are really two forms of transaction we can imagine happening. So one is what we call speculation. So speculation is when you're investing in order to benefit from some kind of change in exchange rates. Right? So we'll give an example here in a minute. Now the other option would be what we call hedging. So hedging is where you're already exposed to some risk because of a possible change in exchange rates, so you engage in currency trading in order to offset those risks. So let's look at a couple examples so that we can get some sense of what each of these means. So first, for speculation, right? Suppose that you, let's say for the moment you're an American, and you believe that the British pound is going to gain value over, say, the next year relative to the dollar. Well, in that case, there's opportunity here to be made. If you believe the pound is going to gain value, then like with any investment, if you hold it while it's gaining value, you're going to make money off of it, right? So what can I do? Well, I have a bunch of dollars as an American. I can take some of those dollars, I can exchange them for pounds, and then hold on to the pounds. If in fact I'm correct, right, while I'm holding those pounds, they will gain in value, which means then when I resell them later for dollars, I'm going to get more dollars than I started with when I bought the pounds. So it's just like buying anything else as an investment. You buy stocks hoping they go up in price. You buy Bitcoin hoping it goes up in price. You may buy silver hoping it goes up in price, right? So it's the same kind of idea. It's just you're investing in a particular currency. Now, hedging is a little bit different. So this would be a case where you're already, for some reason, exposed to some currency risk. So let's suppose that I have a business, and we are regularly selling goods in the Eurozone, and I have a contract, right, where I'm going to be delivering goods in the Eurozone, and I'm going to be paid for those goods in euros 3 months from now. Now, the problem that I have is that I don't actually know what euros are going to be worth 3 months from now. After all, currency values change over time. Maybe those euros are going to gain in value, or maybe they're going to lose in value compared to what they are right now. So in this case, what I can do, I can engage in a form of hedging. Right? So one option to do this, a fairly simple one, is what we call a forward contract. So what a forward contract does, it guarantees a specific exchange rate in the future. Right? So in this case, I'm going to be getting these euros 3 months from now, but I want to pin down what they're going to be worth in dollar terms. So what I can do is engage in a forward contract where I say 3 months from now, I am going to give you this many euros in exchange for that many dollars. This is what a forward contract would do. Right? So it's a way of pinning down what the exchange rate is going to be in the future, so then I don't have to worry about how the value of the euro versus the dollar is going to change in that time. Now notably here, you can use forward contracts not just for hedging. Right? The thing is here that I know I'm going to get euros, but I want to turn them into dollars in the future. Right? So I use a forward contract to cover that. To cover that risk, and eliminate that risk. But I could also use the forward contract as a form of speculation. That is, if I believe that, say, euros are going to, say, which way would this be going? That's one thing. It's very easy for this to get tricky. So the problem that I would have would be it's possible, right, for euros to lose value in those 3 months. Right? So another thing that I could do is say, well, maybe I think euros are going to lose value in those 3 months. So what I'm going to do is I'm going to write a forward contract now at a particular rate where I'm going to provide somebody with euros and they provide me with dollars. But if those euros lose value over that time, right, then when the time comes that I have to provide the euros, I can just buy them cheaply then, sell them at the high price. So this would be something else you can do speculatively. So there's nothing inherent about a forward contract that makes it hedging. It's just one example where if you're trying to cover risks that you would naturally have, then it's hedging. If you're creating new exposure to those risks, then we would consider it speculation. Okay, so let's get some terminology down, because talking about the value of currency, talking about exchange rates can get pretty dicey. Right? So here is the terminology. So when a currency gains value, we would say that it appreciates or strengthens. These are the terms we use. If a currency loses value, it depreciates or weakens. Now, when we look at exchange rates, it's really important to remember that currency is on both sides of the transaction. It's just different currencies. right? So what that means is that because exchange rates are always one currency against another, the value is always relative. Right? So that means if the dollar is strengthening versus the euro, another way of thinking of it is that the euro is weakening versus the dollar. Right? So both of these are happening simultaneously. It's just different ways of describing the same occurrence that's happening. Right? So we're really thinking about, say, if you put two people on a seesaw, right? As one goes down, the other goes up. Right, that kind of thing happens. The same thing happens with one currency strengthening, the other one must be weakening, because we are measuring relative to each other. So one can only go up if the other goes down, and vice versa. Now, another point that comes out of this is that there are equivalent ways of speaking about exchange rates. So you have to be very, very careful whenever you look up exchange rates so you know which direction you're talking about. So for example, at the time that I'm recording this, the exchange rate between Brazilian real and the US dollar is approximately 5 real per dollar. Right? So that is one way we can express the exchange rate, is how many of this other currency can I get per dollar? But you can easily reverse that and say, well, 5 real per dollar is equivalent to saying that it's 20 cents per real. Neither of these is correct or incorrect. In fact, well, I guess you could say both of them are correct. They're equivalent. But because you can state any exchange rate either direction, you really can't say whether the exchange rate went up or down. If it goes up in one sense, it's going to go down in the other sense. So for example, if we drop from 5 real per dollar to 4 real per dollar, then we're going to be increasing from 20 cents per real to 25 per real. So exactly the same change creates an increase along one measure, a decrease along the other. That's why it's really important to use phrases like strengthening, weakening, appreciate, depreciate, as it makes much clearer what is actually happening, whereas just up or down, increase, decrease, when we talk about exchange rates, it creates even more confusion in what can already be a somewhat dicey area of economics. So now let's look at how exchange rates affect different types of people. Because the reality is anybody that is involved with foreign exchange markets will get affected by the strength of the currencies they're involved in. Right? So my wife and I, when we got married, we decided we were going to take a big honeymoon in London. Right? So we went to London. We also spent a day in Paris, this kind of stuff. It was back in 2007. At that point in time, the dollar was pretty weak relative to the US pound. In fact, the ratio is about $2 per pound. Now, just by point of comparison, here I am, I'm recording this now, and for the past several years since I recorded it, we've been closer to about $1 a pound, right? So this 2 to 1 is a really kind of unusual ratio for the two. Now, the result of this was that the honeymoon was very expensive, right? Not because in pound terms we paid for a lavish hotel room or something like that. We definitely did not. It was basically the bed plus a foot on either side of it, rounding up. Right. I guess we were in the UK, so it's basically the bed plus about 30 centimeters on either side of it. So again, rounding up. So not a big room, not particularly expensive. The problem was that I had to exchange a large number of dollars to get the pounds that I needed to do that. And this is kind of an interesting thing on that trip, in that all the prices looked right, which means all the prices were actually twice as high as what I was used to. Right, so we needed lots of dollars to buy the pounds in order to buy the things they were buying while we were in the UK. So, what then would be the effect of exchange rates on various individuals? Right, so if we think about, say, the US dollar, if the US dollar gets weak, right, so that is, the US dollar is losing value relative to other currencies, there are people that are going to benefit, or groups that are going to benefit. One group that's going to benefit would be US companies that export abroad. The reason that they benefit in this case is that when the dollar is weak, that means that it's very easy for foreigners to buy dollars and therefore to buy things from US companies. So it makes things look cheap, right, for US companies that are exporting abroad. Another way to think of it is that their revenue is coming in a foreign currency while they are paying their costs, right, in dollars. Right? So if the dollar is weak, it's effectively lowering their cost relative to their revenue, which is going to make it more profitable for them as well. Right? So you have it makes their goods more attractive, and then also this disconnection, right, between revenue and cost, right, is going to allow them to be more profitable potentially. Meanwhile, foreign tourists visiting the United States, if the dollar is weak, that means their foreign currency can buy lots of dollars. It's very cheap for them to come visit. Or if we have U.S. investors that have investments abroad, if the U.S. dollar is weak, then that means that, say, all of my investments in Japan, right, are now going to be more valuable relative to the US dollar. So if I sell those, I get the Japanese yen, I exchange those yen for dollars, I get a lot of dollars in exchange. Okay. Now, these groups all benefit from the weak US dollar. However, others will benefit from a strong US dollar, right? So foreign companies that are selling in the US, they would benefit from a strong US dollar. After all, if the dollar is strong, that makes it very easy for us to buy foreign currency and therefore foreign goods. Similarly with US tourists traveling abroad. Right, so if things had been different when I visited the UK, if the US dollar had been strong, I could have bought all those pounds cheap and therefore bought all the stuff that I bought on vacation cheap. And then foreign companies that have investments in the US. If you invest in the US and the US dollar is strong, then when you sell those investments, they are much more valuable when you convert back to your home currency. Right, so both the weak dollar, the strong dollar, have people that are going to benefit from it, and both of them are going to be combinations of Americans and foreigners as well. Now, therefore, we can back up, right, and just make a broad observation. And that is that a strong currency is not necessarily good. A weak currency is not necessarily good. The question should always be good for whom, right? So a strong currency, really good for American tourists traveling abroad. A weak currency, really good for American exporters that are selling abroad. Right? It's not obvious that we should choose one of these groups over the other, right? So like with many things in economics, it's a matter of point of view. Who is it that's going to benefit from the particular policy that we're looking at? Right, so we've talked about exchange rates, kind of the source of demand, the source of supply being investors, tourists, and those engaged in international trade. So what affects exchange rates then? Well, it's really typically down to four main factors. First is your expectations about future foreign exchange rates, right? So this would be that speculation, right? So if I'm an investor and I'm thinking that maybe the pound is going to gain value, what's that going to do? It's going to increase the supply of dollars that I provide. It's going to increase the demand for the UK pound. So what happens? Well, the British pound now has greater demand for it, so its value is going to increase, it will appreciate, it will be stronger, whereas the supply of dollars has increased as well. This makes the dollar weaker, it makes it depreciate. Another thing that has an impact is differences in the rates of return or interest rates, right? So again, thinking about me as an investor, if when I look at the world, I see that, oh, in fact, I can earn a much better return in Australia than I can in the United States. In that case, I'm going to take my US dollars, I will sell them, and I'm going to buy Australian dollars. What does this do? This means then that we have an increase in the demand for the Australian dollar, that would lead to appreciation there. Increase in supply of the US dollar, that's going to lead to depreciation there. So if you have higher rates of relative return, that's going to increase the demand for your currency relative to others, thereby leading to appreciation. With relative inflation, suppose that I believe that the US is going to experience fairly high inflation relative to other countries. Well, in that case, I don't want to hold American dollars. They're going to lose value pretty quick. Right, so I'm going to invest somewhere else. Right? Now, this high rate of relative inflation that I expect will decrease the demand for my currency and therefore lead to depreciation of that currency. Now, in the long run, we typically talk about purchasing power parity as being what determines how exchange rates are going to relate to each other, as in effect determining the ratio between exchange rates. So let's look at purchasing power parity in a little bit more detail. So purchasing power parity is all based on the concept of arbitrage. So arbitrage, all it really is that you're taking advantage of a price difference in different markets by buying in the cheap market, reselling in the expensive one. Right? So real simple, silly example. So I live in Ohio. I'm basically halfway between Akron and Canton where I live. Right? So let's suppose that there is, for whatever reason, there arises the significant difference in price for green beans between Canton and Akron. So that in Canton they're $1 per can, and Akron they're $2 per can. Well, if this is the case, I can make a business reselling green beans. Right? So every day I can come down to Canton, I can buy up a whole bunch of green beans, and then I can hop on I-77, drive basically a half hour to get up to Akron and then resell these green beans for $2. So every single one of those cans of green beans, I just made $1 on. Now, it turns out this has an effect on those markets. Right? So as I and other people like me figure out there's a price difference, we're going to see a big increase in demand in Canton, driving that $1 price up. At the same time, as we drive down the road and resell in Akron, we're going to see a big increase in supply in Akron. As we have that increase in supply, that will drive the $2 price down. Right? So this price difference that we have is going to tend to squeeze over time as arbitrage happens. And this is exactly what we'd expect to happen in foreign currency markets. So let's apply it there. Right, so this is really just the law of one price is what we call it. That is, for a single good, you will see a single price, or more or less one price, applied across markets. And that's also true even if we're looking at different currency zones. Right, so suppose that a can of green beans is $1 in the US, but 50 pence in the UK. Well, in that case, the only way, right, for it to make sense for us not to just throw a bunch of cans of green beans onto ships and ship them across the Atlantic is for us to have an exchange rate between the two that is consistent with that $1 being equivalent to 50 pence. Or, if we adjust this a bit, it would be $2 per pound. Right? So either way you state the exchange rate is correct, but it needs to line up with the prices of the goods. So any other exchange rate here is going to create arbitrage opportunities, as we're going to have cheaper green beans either in the US or in the UK if we have any deviation from this 2-to-1 ratio. So purchasing power parity is really based on this concept. That is, the same money should be able to buy the same stuff regardless where it is. Right? So if I take my dollars and I convert them to pounds and I buy stuff in the UK, I should be able to get the same stuff as if I had just taken those original dollars and bought in the US. Now the way that we do this is not going to be true for every single individual good. After all, there may be differences in relative local demands for goods or whatever, right? But what we would say is that if we look at a basket of goods, right, it's very much like we do when we look at things like consumer price indices and the like. If we look at that basket of goods should be basically the same in terms of its overall cost between one country and another, and that would predict then what the exchange rate has to be between the two. Now, really important notes on the production possibility frontier, purchasing power parity. And that is, first, purchasing power parity is a long-run concept. We do not expect for it to apply day to day for a simple reason, and that is that the international arbitrage would be really hard to pull off, right? So for me, with the cans of green beans between Akron and Canton, it is like literally like a 20-minute, half-hour drive between the two cities. It's not going to be that time-consuming, that resource-consuming for me to fill trucks with green beans and then move to the other location. However, this is not so true once we start looking internationally. Right? So if these cans of green beans do in fact have different prices once you've adjusted for currency across the Atlantic, getting across the Atlantic is pretty hard. Right? It's time-consuming for one. It's also very expensive. Right? So what that means then is we're not going to see international arbitrage be quite as powerful as arbitrage that is much more local. Another point is that the exact relevance of purchasing power parity isn't entirely clear. Right? So a lot of the time when we measure things like the consumer price index, we're looking at a really broad basket of goods. We want to capture all the stuff that people buy. And it turns out, empirically, when we try to use such baskets, purchasing power parity honestly just doesn't work very well. The data does not seem to align very well with the expectation that we would expect from arbitrage being a significant factor. Now, this really shouldn't be that surprising, because there are some goods or services that would be included in the consumer price index that are just not tradable at all. Right? So, for example, haircuts. If haircuts are cheaper in Mexico than in the United States, I am not going to start buying haircuts in Mexico, because it's just really expensive to get there. Right? And also, haircuts are not something that I can easily buy in bulk and resell or something like that. Right? All to say that there are specific goods or services that where you wouldn't expect the conditions necessary for purchasing power parity to really work very well. right? So especially if there's a very large cost of transportation relative to the price of the good. That's a huge thing. Also, if just technically it is difficult or impossible to resell the good or service, that also would create a barrier, right? So it doesn't work very well for the broad basket. However, if you narrow the basket down to just tradable goods, so goods that are not outrageously expensive to move, and also that where it is possible to resell them, so things that can reasonably be traded. In that case, we do see that purchasing power parity works significantly better for those goods than for things like haircuts. So now let's turn to the macroeconomic impacts. Right, so there are three main things we're going to look at. One would be the impacts on trade. Another would be the impacts on long-term investment. And then finally would be the effects on the financial system. So now let's look at trade effects. Right, so if we have a strong US dollar, what happens is that it becomes expensive, right, for foreigners to buy the dollar. Strong US dollar, it's very valuable. Right, now because it's expensive for them to buy the US dollar, it's also going to be expensive for them to buy American goods. After all, they need dollars to do that. Right, so what we expect to see then is that we in the US are going to export less, simply because our exports look more expensive to the rest of the world. At the same time, we're going to have an easier time importing from the rest of the world. We have a strong dollar, which means that dollar can buy lots of foreign currency, so therefore it's relatively cheap for us to buy things from foreign countries. Now, the net effect of this in aggregate demand, aggregate supply terms is that a strong US dollar will tend to lead toward lower aggregate demand as we export less, import more, so that's a negative for our net exports. Now, if we have a weak US dollar, the opposite happens. With a weak US dollar, well, the dollar's cheap, that makes our goods cheap. After all, you have foreign currency, you can buy lots of dollars, therefore you can buy lots of American goods. On the other hand, if we have a weak US dollar, then it's really expensive for us to buy foreign currency, which means then it's also going to be expensive for us to buy foreign goods. Right, so we would see then fewer imports. More exports, fewer imports, that's going to be an increase in aggregate demand that occurs. Now let's look at long-term investment effects. Well, the reality is that when we look at long-term investments, right, then really a strong currency or a weak currency really doesn't have much long-term effect. Rather, what's more important is that you be predictable. Right? So fluctuations are bad from a long-term investment perspective, simply because it makes planning more difficult. The reality is, as long as I know what's going to happen to currencies over time, I can hedge. Hedging is a possibility. It's just when things are not predictable that it becomes much more difficult for us to hedge, for us to plan, and therefore, if it's hard for us to plan, it's hard for us to invest, right? So in case of investors typically just want a predictable currency rather than a high fluctuation currency. And finally, we look at the financial system effects. There is the problem in that fluctuations can actually destabilize your banking system, especially if your banking system is involved with international investments. So a classic example of this was the Southeast Asian crisis that happened during the 1990s. So let's look at this case in a little bit more detail, as I think it's going to help to illuminate what exactly is going on here. So imagine we have a bank in Thailand, right? And what they decide to do, Americans are very interested in investing in Thailand. It's a developing country. They see lots of potential there. So in this case, what Thai banks do, they're borrowing US dollars from American investors who are very happy to lend. They then take those dollars because they want to lend locally. They don't need dollars. What they need is Thai baht. Right, so they go out, they sell the dollars, they buy the Thai baht. This would help strengthen the baht, by the way. And then once they have those baht, they lend them out so that people in Thailand can start businesses and buy houses and whatever it is that they happen to want to do, right, with the money that they've borrowed. Right, so the effect of all this is the bank now has assets that are denominated in baht, but liabilities that are denominated in dollars. What this then means is if there's any change in the relationship between the two, right, then this bank is now vulnerable to changes in that exchange rate. Right, so let's walk through an example. This is actually very similar to something that did happen during the Southeast Asian crisis. Okay, so the Finance One, and say it's the name of a Thai bank, it actually was the name of a Thai bank. Let's say they borrow $1 million from American investors. At that point in time, let's say the exchange rate is 30 Thai baht to the dollar. In that case, they take the $1 million, they convert into 30 million baht, they then take that 30 million baht and they lend it out. Then time passes, and let's just say that in that time, the Thai baht loses value. Now, because the Thai baht has depreciated, that means then that they're going to need more baht to buy back a dollar than before. So let's just say that it's 40 baht per dollar. Right, so time goes on, Finance One gets paid back, right? They're paid that 30 million baht that they had lent out, and I'm ignoring interest here for a minute, just to make the point. Right, so they're paid 30 million baht, they convert that over to dollars, and what they find out is that now they only have $750,000. That's not enough for them to pay back the $1 million loan. What that means then is, as a bank, Finance One is now insolvent. I'm really simplifying here, saying this is their only loan or whatever, right? But they're in serious trouble. And it really was because they had assets in baht, liabilities in dollars, the baht lost value, which meant their assets lost value. And that ate into and in fact destroyed the bank capital, so that now in the end, they're in serious trouble, insolvency. And this is what happened in Southeast Asia. We saw Finance One go under, and then suddenly investors start getting nervous, right? So what do? Right? Money starts leaving the area. Right? So we see a lower demand for local currencies, and as we have lower demand for local currencies, that's going to depreciate those currencies. So again, all those assets and local currencies are now losing value quickly. Meanwhile, the liabilities in dollars are not losing value, and we are seeing bank after bank becoming insolvent. So the problem just gets worse because of because of investors pulling out of the area. Well, this is a problem we call contagion. So contagion is the term we use when a problem spreads from one country to another, as individual investors or international investors treat countries not individually, but as a single region, right? So if we're thinking of, say, Thailand and, Indonesia, for example, if we think of them as being basically the same, right, then when things are bad in Thailand, we start pulling out of Indonesia. Now, when this was happening, the president at the time said that they're all different countries, right? Well, not necessarily in the eyes of investors, and it's the eye of the investor that really matters at this point. Now, I do want to note that generally speaking, the United States is not as susceptible to these types of problems, the big reason being the strength of the dollar. That is, the dollar being so widely accepted. So what we tend to do, we borrow in dollars and we lend in dollars, which means then we don't have nearly as much risk, right, from these exchange rate movements. I suppose this is one of the benefits to the United States of the dollar playing such a big role in the world economy. Now, I wanted to just take a quick moment to talk about the direction of causation. Right, so much like how in microeconomics, we can reason two ways. Right? So one is to say if we have an increased price for a good, then quantity demanded will fall. Right? That is, we respond to a higher price by demanding less of the good. However, if there's a greater demand for the good, this leads to an increased price. So this would be a shift in demand. Right? All to say, the direction of causation has a big impact. So the question is it the price is changing and therefore buyers are responding to it, or is that buyers are changing and therefore having an impact on the price? Right, so this also works for exchange rates. Right, so suppose we have an increased demand for dollars because foreigners want to invest in the US. Right, so what does that do? Well, we have a strong US dollar then. But as we have a strong US dollar, as we mentioned before, we'll see falling exports and rising imports. We'll see a trade deficit happen. On the other hand, it's also perfectly possible that maybe Americans just love foreign goods, in which case we'll see rising imports as we're buying from abroad. That is a trade deficit again. But in this case, those rising imports increases the supply of dollars available in the market. As we're taking those dollars, using them to buy foreign currency, so we can buy foreign goods. So we end up with a weak US dollar. Now, because of the weak US dollar, US investments are going to look cheap, and that leads to a financial surplus. Right, so what you notice here is this trade deficit. It can be connected with a strong dollar. It can be connected with a weak dollar. It's all a matter of which direction causation is flowing. Right, so if it's connected with a strong dollar, the strong dollar causes a trade deficit. If it's connected with a weak dollar, the trade deficit causes a weak dollar to happen. Now, I'd also note that this example and counterexample describe how the balance of payments is achieved in the United States. Right? That is to say that foreigners want to invest in the US. What does that mean? That means we have a financial surplus. So financial surplus is there. This leads to the strong dollar, which creates a trade deficit. So add together the trade deficit and the financial surplus, and they cancel out. Same thing happens on the opposite side, right? So we want to buy lots of goods from abroad. We have a trade deficit. This then, though, turns the US dollar weak because we really just want to use our dollars to buy foreign stuff. As the US dollar gets weak, now our investments look cheap, right? So that leads to a financial surplus, which again offsets the trade deficit. So that is something that I know much earlier in the course we talked about the balance of payments, and I kind of waved my hands about why these would balance. This is exactly why. Right? That is a deficit or a surplus in one, right, will then change the exchange rate, which creates an offset in the other account. So now let's take a few minutes to talk about exchange rate policy. Now there are four main options for how we can have policy related to foreign exchange rates. So one would be what we call a floating exchange rate. We'll look at these in more detail in a minute. A second would be what we call a soft peg, that is sometimes called a dirty float. A third would be the hard peg, and then finally is the merged currency. So let's look at the floating exchange rate first. So a simple example of that, the US. We have a floating exchange rate. That is to say that we don't really intervene in any significant way to try to regulate the value of the dollar versus other currencies. Right, so we're just allowing the exchange rate to fluctuate, right, based on whatever market forces do. Now there are some significant benefits to this. One being that it's very easy to implement. You don't actually have to do anything. So just let people buy and sell your currency. Another benefit of this is that it provides lots of freedom for domestic monetary policy, right? So because sometimes we want to increase the money supply or decrease the money supply to hit inflation targets, that kind of thing. With a floating exchange rate, we can do this because we're not trying to use the money supply to do anything else. Right, now the downside though is that we may end up with a very unstable exchange rate because we're not really trying to stabilize it. A second option would be a hard peg. Right, so a hard peg, also called a fixed exchange rate, is where you have the central bank intervene in foreign exchange markets to maintain a very specific exchange rate. Now there are some countries that do this. So one example that I can think of would be the Bahamian dollar. Right, so the Bahamas pegs their dollar one for one with the US dollar. Now the reason for this is, that it's going to help us have good trade right between the two. So in the Bahamas case, they're very interested in tourists coming in from the United States. So having their currency be effectively equivalent to the US currency is really helpful to them. And now, however, in order for you to do this, it requires the central bank to hold foreign currency so that they can then intervene in these markets to buy and sell as necessary. Now you can always sell more of your own currency, you can just create it. But you need to hold the foreign currency because sometimes you're going to need to be able to sell that. Right, so how this works, just a simple example, if your currency starts appreciating, what that means now is that you need to supply more of your own currency to foreign exchange markets, and that's going to hold the value down. On the other hand, if your currency starts depreciating, what you need to do then is to buy your currency. But you can only buy your currency if you have foreign currency with which to buy it. So what we'll tend to see here is that foreign central banks that are engaged with hard pegging are going to hold fairly large amounts of foreign currency so that they can engage in these kinds of transactions. So the big benefit of doing this is that it provides you with a stable exchange rate. We know stable exchange rates are really good for long-term investment, really good for financial stability. The downside, though, is that it means you don't actually have any control over monetary policy domestically anymore. If you're worried about inflation, sorry, you've already found something you're trying to target. That's the exchange rate, and you're going to have to be willing to increase your money supply or decrease your money supply in order to affect that exchange rate. Right? So you can't really use monetary policy for domestic goals. Right? Now there is something called a soft peg, which is really an attempt to split the difference between the hard peg and floating by just using occasional intervention. So something like a soft peg is, well, yeah, our currency is depreciating, we're okay with it happening, but we don't want it to happen too fast. So in that case, we would still need, right, some foreign currency to be able to slow the rate of decline, but we're not trying to fix any specific value. Right? So this would be sometimes called a dirty float or a soft peg, depending on kind of which direction you want to come at it from. But it's the same basic idea. The government will intervene occasionally to prevent really large changes in the exchange rate, while most of the time allowing small changes to occur. Now, there is a significant risk to hard pegs, and that's what we call a speculative attack. Right? Because the central bank has to have a foreign currency in order to hold on to the value of its own currency, there's the potential here that they might run out. After all, if you start losing value, well then you need to buy up your currency and you need to use foreign currency to do that. If you don't have any foreign currency anymore, you've lost. You can't hold on to it. So this is something that we call a speculative attack. It's an investment strategy. Right? That is simply a bet that the central bank won't be able to hold up an exchange rate. Now this was something that George Soros made a lot of money doing. I've heard it said that George Soros made all of his money just betting against central banks, and it turns out betting against central banks is a pretty good bet. So here's how this works. Right, so it starts out, say, George Soros says, I think that the Thai baht is going to lose value. Right, so what he does, he says, I'm going to therefore, right, well, the problem is I don't have any baht to sell and then invest in something else, so I'm going to borrow a bunch. Right, so we're going to borrow 40 million baht. And let's just say that the official exchange rate at this point in time is 40 baht to the dollar. Right? So we take the baht, 40 million of them, we change them into dollars. Right? So we now have $1 million. Now the thing is, when you do that, because the Thai central bank is trying to hold on to that exchange rate, when large amounts of money change from one to the other in the foreign exchange markets, the central bank has to step in and provide some of that foreign currency to keep its exchange rate holding. So yeah, now we have $1 million. A good chunk of that came from the Thai central bank, right? Which means now the Thai central bank is in a worse position to hold on to their peg. Right? So we did this. You know what we can do? We can do it again. Borrow another $40 million, change it into, not $40 million, 40 million baht, change it into $1 million. And now we're eating into the central bank's reserves time and time again. And it's getting harder and harder for them to hold on to that peg as they are losing reserves very, very quickly. Once they lose dollar reserves, they can't hold on to the thing anymore. Right? Which means eventually they have to adjust the peg. Right? So they say, all right, fine, we're going to adjust it. It's no longer $40 40 baht to the dollar. It's 50 baht to the dollar. So the baht is now less valuable. It takes more of them to buy a dollar than before. But it then means that when I have that $1 million and I have a 40 million baht loan that I have to pay off, take my $1 million, I only convert 800,000 of it into baht, multiply with the 50, that gives me the 40 million that I need, right? So I can pay off my loan, and now I just have $200,000 for free. And so just to work this all out again, make sure that we're following. 40 million baht, convert to $1 million. I still have that 40 million baht loan, right? And I have $1 million on hand. Then the currency exchange rate changes, so it's $50 to the baht, 50 baht to the dollar, right? So if I took all of my $1 million, I get a 50 million baht, so I can pay off my 40 million loan without a problem and have 10 million baht left over. Well, I don't want 10 million baht, so I can convert those back into dollars. That's $200,000. So this would be another way to think of it, right? So the point being that when you do this, if you are successful, you can make a lot of money having invested basically nothing. Because remember, it all started with a loan. Right? As long as you can find somebody to lend to you, then you're good to go. Now, how do you prevent speculative attacks? Now, the big thing you would have to do is what we call capital controls. Capital controls simply means you are preventing foreigners from being able to invest in this kind of way, right? So you control, right, capital flows. It's really that simple. Now, if the foreign exchange markets are small enough, then it's actually not that hard. Right? You can also just not allow foreign investment to happen. Right? And we might even need to limit say the amount of actual trade in goods and services as well, right, in order to prevent these kind of speculative attacks from occurring, because there may be creative ways of taking advantage of such markets, right? So all to say, you're not going to be able to have a robust trade, a robust investment with the rest of the world if you're really trying to prevent these speculative attacks. So one more option would be a merged currency. Right, so a merged currency, probably the best examples here would be the Eurozone. The Eurozone would be a very traditional merged currency where we have multiple countries that have decided to adopt a single currency that does not really belong to any one of those countries. But then we also have economies that we would call dollarized, or that engage in currency substitution, which I've mentioned before. Now, dollarized doesn't necessarily mean that they use the US dollar. They could use any other country's currency. The big difference here is that with a dollarized economy, it's a unilateral decision on the part of one economy to adopt, right, a currency that's really primarily controlled by a different economy. Right? Now, one thing this would do is it solves speculative attacks. If we're all using the same currency, there's no way you can use speculative attacks. Right? Another benefit is that more than any other option, this makes it easy for us to trade, easy for us to invest across borders. After all, we are using exactly the same currency, right? So there really isn't any barrier. Right? So I'm not worried about my ability as an Ohioan to invest in New York City. Currency is not a problem here. Right? If I want to invest in New York City, I can easily do that. In fact, indirectly I do that. It's the New York Stock Exchange, right? So I'm investing in New York City, in their stock exchange, because we use exactly the same currency. Right? So it's very, very easy for us to do this. Similarly, if you want to, say, work in one of these countries and then reside in another one, this tends to be relatively easy. If I want to buy goods in another state, I can easily do that. We all use the same currency. Similarly, in the Eurozone, you can buy goods in a different country, and it's not really a big problem. You don't have to worry about exchanging money because you're using the same money. Now, the downside here is that you do lose control of domestic monetary policy, right? Because you no longer have your own money, right? So you can't really have monetary policy anymore, right? So one concern, for example, that exists in the Eurozone is that Germany is a very large economy, and the Germans seem to have a lot of influence over how the European Central Bank works, right? So some economies inside the Eurozone don't love this fact because the Germans are extremely cautious about the levels of inflation, whereas some other members of the Eurozone may be somewhat less cautious, right? So there is some conflict that can happen here between the various members of the Eurozone because they want different things, right? Some have different attitudes than others are related to their attitudes toward inflation. So that is one of the downsides of a merged currency, is that you do lose domestic control of monetary policy. So all of this highlights what we call the exchange rate policy trilemma. Right? So you can imagine these as points on a triangle. Right? So we have free trade as one point, exchange rate stability is the third, and then domestic monetary policy. Free trade is one point, exchange rate stability is a second, domestic monetary policy would be the third. Right? And you can choose any one side of this triangle. What that means is you're going to lose a point. Right? So you get to choose 2 out of the 3 in effect. Right? So you can choose number 1 and 2. Right? So you want free trade and capital flows, you want exchange rate stability. What provides that would be merged currencies. You don't even have to worry about exchange rates at all because you're using the same currency. Right? So merged currencies are perfect for that combination, but you totally lose domestic monetary policy. Or maybe you want free trade, you want free capital flows, and you still want domestic monetary policy. Well, if that's the case, you need to sacrifice exchange rate stability. Floating currencies will do that for you. Right? Or maybe you say, you know what, I'm willing to sacrifice free trade and capital flows. What I really want is exchange rate stability and domestic monetary policy. A pegged exchange rate with capital controls will do that for you. Right? So of these 3, you get to pick 2. You have to sacrifice 1. And it's not immediately obvious which of them is the best to sacrifice. This is something that is probably going to depend very much on the specifics of your country. So just some closing thoughts then related to this. One is that the exchange rate in conjunction with the balance of payments provides some clues, right, about causation. A second point is that the exchange rate connects lots of pieces of the economy. Right? So financial aspects and the trade aspects get connected through the fact that the exchange rate matters for all of them. And then finally, the story of the trilemma, right, tells us that we have to sacrifice something. Right? Between free trade and investment, exchange rate stability, and domestic monetary policy, one of them has to go.